On July 28, 2026, roughly $250 billion evaporated from Nvidia's market value in a single trading session. Not because of a bad earnings report, not a product recall, not a scandal. A meaningful chunk of that sell-off traced back to a report out of Shanghai about a machine most people have never heard of, built by a company most people couldn't name, doing a job most people don't fully understand. By the time markets closed that week, ASML, the Dutch company that has quietly controlled one of the most important choke points in the entire global technology supply chain for decades, had lost billions of euros in value. Samsung closed down more than 13%, its worst single-day fall in almost 2 decades. SK Hynix dropped even further, around 7%. South Korea's Kospi index closed down roughly 8%, triggering a market-wide circuit breaker, and then triggered another one the very next day, the first back-to-back circuit breaker event in the exchange's history. AMD and Micron both slid. This wasn't a bad day for one company. This was a genuine across-the-board panic that rippled through the entire global semiconductor industry within about 48 hours. So what actually happened? A machine. China started mass producing in small numbers a version of the single most important piece of equipment in modern chip making. The kind of machine that, until very recently, only one company on Earth could reliably build at the cutting edge. Here's the honest, fully sourced version of what happened, what it actually means, and, just as importantly, what got overstated along the way. To understand why this news triggered panic instead of a shrug, you need to understand just how uniquely powerful ASML's position in the chip industry has been. Every advanced computer chip, from the processor in your phone to the AI accelerators running the world's biggest data centers, starts as a blank silicon wafer that needs incredibly precise patterns etched onto it, patterns measured in nanometers, a scale that's genuinely difficult to fully picture. The machines that perform this etching are called lithography systems, and they're some of the most sophisticated pieces of industrial equipment humans have ever built, combining precision optics, laser systems, and mechanical engineering into devices that can cost upward of $100 million or more each, particularly at the most advanced end. For decades, one company, ASML, based in the Netherlands, has held close to a total monopoly on the most advanced versions of this equipment. Not just a dominant market share, an effective monopoly on extreme ultraviolet, or EUV, lithography machines. Specifically, the category needed to produce the most cutting-edge chips in the world. Every major chip maker on the planet, TSMC in Taiwan, Samsung in South Korea, Intel in the United States, has depended entirely on ASML for that top tier of equipment. That concentrated control is exactly why lithography has become one of the central battlegrounds in the broader technology competition between the United States and China. Export restrictions have specifically targeted ASML's most advanced EUV machines, blocking their sale to Chinese chipmakers for years, precisely because controlling access to this one company's equipment has proven to be one of the most effective tools available for slowing down China's domestic chipmaking ambitions. It's worth understanding briefly why lithography specifically became the choke point, rather than some other stage of chip manufacturing. Chipmaking involves dozens of separate process steps: deposition, etching, cleaning, testing, packaging, and China has made real, if uneven, progress across several of them. But lithography is uniquely difficult to replicate because EUV machines in particular require an almost absurd level of precision, generating extreme ultraviolet light by vaporizing microscopic droplets of molten tin with a laser 50,000 times per second, then bouncing that light off mirrors so perfectly smooth that if you scaled one up to the size of Germany, its largest imperfection would be smaller than a millimeter. ASML doesn't build every component itself. Critical parts come from suppliers like Zeiss for optics and Cymer, an ASML subsidiary for the laser light source, but ASML is the only company that has managed to integrate all of it into a working commercial system. That's the specific reason a DUV breakthrough, while genuinely significant, is a meaningfully smaller story than an EUV breakthrough would be. DUV technology dates back decades and is fundamentally less complex, even though building a reliable, high-volume immersion DUV system domestically is still a serious engineering achievement in its own right. Here's where I need to be precise, because a lot of the coverage blurred two different companies together, and getting this right matters. On July 27, 2026, Reuters and The Information both reported that a state-backed Shanghai group had begun mass-producing immersion deep ultraviolet, or DUV, lithography machines domestically. Reuters identified the company as Shanghai Aishengna Electronic Technology Group, a secretive firm with no public website that has disclosed almost nothing about its own operations. What reporting has established is that Aishengna built its production capability by absorbing engineering teams from 2 other Chinese players: Shanghai Yuliangsheng Technology, a startup founded in 2022 and jointly backed by Huawei-affiliated equipment maker SiCarrier and state-backed Chuang Kewei Technology, and Shanghai Microelectronics Equipment, or SME, a longtime veteran Chinese lithography developer that reportedly transferred technology from its SS-A800 lithography program to Yuliangsheng during 2025. The original transcript referred to a single company, Shanghai Yulong Sheng Technology, or Shanghai Yulonging, founded in 2022 with roughly 1 billion yuan in registered capital as the company behind the mass production announcement. Reporting indicates these are actually two related but distinct entities. Shanghai Yuliangsheng Technology, the 2022 founded Psi carrier-linked startup that has been testing a DUV prototype at SMICS since September 2025, and Shanghai Aishengna Electronic Technology Group, the separate state-owned entity that Reuters identified as the one that began mass production in July 2026 by absorbing Yuliangsheng's and SMI's engineering teams. The exact registered capital of Aishengna has not been publicly disclosed. According to that reporting, the production target is roughly 5 of these immersion DUV machines in 2026, scaling up toward approximately 20 units by 2027, with initial customers expected to include SMIC, Huahong Semiconductor, and CXMT, 3 of China's most important domestic chip makers, all reportedly named as recipients in the reporting. It's worth being precise about exactly what kind of breakthrough this is, because the framing matters enormously. This is not an EUV machine, the more advanced category that ASML alone produces, and that remains fully restricted from export to China under current controls. This is a DUV immersion machine using 193 nanometer light passed through a layer of water between the lens and the wafer to print finer features than dry lithography allows. It's a less advanced category of equipment than EUV, but one still genuinely capable of producing meaningfully useful chips. Reporting indicates the domestic machines are targeting roughly 28 nanometer class production, several process generations behind ASML's most advanced commercial DUV and EUV tools. Even so, producing a functional immersion-capable DUV lithography machine domestically without relying on ASML components represents a real technical milestone, one Chinese equipment makers have been visibly working toward for years, including an earlier episode reported by the Financial Times in which SMIC began testing a Yuliangsheng-built prototype back in September 2025. Let's walk through what actually happened in the markets, because the scale of the reaction tells its own story about how sensitive this particular choke point has become, and because 3 separate shocks landed in almost exactly the same 48-hour window, which the original telling of this story collapsed into one. ASML shares fell roughly 7% to 8% at their lows on the Monday the report broke, hitting their lowest level since early June, before partially steadying over the following days. Unverified. Remove or check. The original transcript's specific claim of a share price around 165 $90 and an exact 55 billion euro loss figure could not be independently confirmed from available reporting and should be treated as approximate rather than precise. The damage spread well beyond ASML itself. Applied Materials, Lam Research, and KLA Corp, 3 major US semiconductor equipment makers whose businesses don't even directly overlap with ASML's lithography franchise, each fell somewhere between roughly 4% and 7% in sympathy. As investors reassessed the broader competitive landscape for equipment suppliers generally, AMD and Micron both declined as well, with Micron down in the mid-single digits and SanDisk falling around 11% at one point in the following day's trading. Nvidia fell nearly 5% on July 28, 2026, erasing approximately $250 billion in market value in a single session. But here's an important nuance the original telling of this story missed entirely: that Nvidia decline wasn't driven by the DUV news alone. Reporting from that period attributes the drop to a combination of factors hitting at once. Renewed circular financing concerns tied to Nvidia's roughly $250 billion financing arrangement with OpenAI, a separate $250 billion figure from the market value number, which is a coincidence worth flagging so the two don't get conflated, alongside the broader wave of China competition anxiety the lithography story fed into. The original transcript presented Nvidia's $250 billion market value loss as driven specifically and solely by the ASML lithography news. Reporting from the period indicates Nvidia's decline was driven by a mix of renewed skepticism about AI infrastructure financing arrangements, including Nvidia's own roughly $250 billion OpenAI financing deal, combined with broader China competition concerns, the DUV story amplified, rather than the lithography report being the sole or even primary cause. South Korea's semiconductor sector took the hardest hit of all, and for a similarly layered reason. Samsung Electronics closed down 4% on July 28th, its worst single-day performance in nearly 2 decades. SK Hynix fell even further, around 7%. Together, since the two companies make up roughly half of the Kospi's total weighting, the benchmark index closed down 8%, its biggest one-day decline in months, and triggered Korea's circuit breaker mechanism. Remarkably, a second circuit breaker fired the following day too, the first back-to-back trigger event in the exchange's history. Japan's Kioxia, a major flash memory maker, fell more than 18%, and Taiwan's MediaTek dropped nearly 10%. Analysts who covered the Korean sell-off specifically pointed to three converging catalysts rather than one, the Daewoo lithography reports. CXMT's roughly $8. $6 billion initial public offering, the largest Asian tech listing of 2026 at that point, which stoked fears of an approaching DRAM oversupply as China's memory chip capacity expands, and the same renewed AI financing anxiety hitting Nvidia. Corrected. The original transcript framed the entire Korean market rout as a direct reaction to the lithography news specifically. Multiple contemporaneous reports attribute the sell-off to at least three simultaneous factors: the DUV production news, CXMT's IPO, and its implications for global DRAM supply and broader AI financing sentiment, making the lithography story an important contributing factor rather than the sole cause. CXMT, or Changshin Memory Technologies, is worth a brief detour here because its IPO timing wasn't a coincidence relative to this story. Both events reflect the same underlying dynamic of China's memory and equipment sectors, maturing faster than many Western investors had priced in. CXMT's Shanghai listing raised roughly $8, $6 billion, with proceeds explicitly earmarked for expanding domestic DRAM production capacity. For South Korean investors specifically, that mattered enormously since Samsung and SK Hynix derive a large share of their earnings from memory chips, and any credible signal of accelerating Chinese memory capacity. Arriving in the same week as evidence that China might also be gaining domestic lithography independence reads as a double threat to the entire Korean memory chip investment thesis, not just a single isolated data point. It's a good illustration of how, in fast-moving technology sectors, unrelated news events can compound each other's market impact, even when the underlying technical developments aren't directly connected. Separately, SK Hynix's own quarterly results landed right in the middle of this window too. The company reported record second quarter 2026 operating profit, up more than 550% year over year, driven by soaring demand for high-bandwidth memory chips used in AI accelerators. Even those record results missed some analysts' already elevated expectations, which contributed to the second circuit breaker trigger the following day. That's a useful reminder that even genuinely excellent underlying business performance can still produce a stock decline if a company has been priced for something even more exceptional. That's an extraordinary amount of value destroyed across an entire industry, and it's worth being honest that it wasn't triggered purely by a relatively small number of lithography machines that, by the company's own targets, won't reach meaningful production volume until 2027. The size of the reaction tells you investors weren't just pricing in 5 machines this year. They were pricing in several compounding anxieties about China's trajectory, global memory supply, and AI spending sustainability landing in the same news cycle. There's an additional piece of context worth adding here that the original telling of this story left out entirely. ASML's exposure to China has actually already been shrinking for a while, which arguably made the market's reaction even more of an overcorrection. According to industry data reported by Xenospectrum, China's share of ASML's total revenue fell from roughly 33% down to around 16% over recent quarters, well before this specific DUV story broke, largely because export restrictions had already been tightening the pipeline of what ASML could legally sell into China. That decline had been happening gradually and had already been priced into ASML's stock over time. The DUV news didn't suddenly reveal a huge new exposure. It revealed a threat to the remaining DUV revenue China still generated for ASML, the legacy equipment category that had been filling some of the gap left by the EUV export ban, which is a real concern, but a narrower one than ASML's entire China business is now at risk, which is closer to how some initial coverage framed it. Now here's where I need to slow down and give the complete picture, because a lot of the breathless coverage of this story leaned hard into the dramatic stock chart without spending enough time on what serious industry analysts said afterward. Multiple outlets, including reporting relayed through Asia Times and TechWire Asia, quoted Chinese and international semiconductor analysts urging real caution about how much this changes in the near term. The numbers make the gap clear on their own. ASML currently ships somewhere around 130 immersion lithography systems annually, representing decades of refined manufacturing process, proven reliability, and deep customer relationships. China's new domestic effort is targeting 5 machines in 2026, climbing to perhaps 20 in 2027. That is nowhere close to competing with ASML's actual production volume. even before getting into questions of technical performance. And performance is exactly where the bigger question marks remain. Analysts specifically flagged concerns around yield, the percentage of chips coming off the machine that actually meet quality standards, throughput, meaning how many wafers the machine can process per hour, and long-term reliability under sustained industrial use. These are precisely the areas where ASML's decades of accumulated engineering experience show up most clearly. And they're notoriously difficult to replicate quickly, even once the basic underlying technology has been demonstrated to work at all. One assessment specifically described China's DUV lithography as still lagging ASML by roughly 4 full technology generations, and noted that neither the level of domestic versus imported component sourcing inside the new machines, nor real production scale throughput and defect rate data had been publicly disclosed as of the initial reports. JP Morgan analysts specifically called the scale of the equity sell-off disproportionate to what the underlying report actually indicated. And ASML, B Semiconductor Industries, and Infineon Technologies all partially rebounded within days of the initial announcement as that reassessment spread through markets. So if the near-term production impact really is this limited, why did markets react with such genuine panic? This is worth understanding because it says a lot about how these kinds of strategic technology stories actually move markets. Markets don't just price in what's true today. They price in trajectories, and they price in psychological shifts in how a competitive landscape is perceived going forward. For years, ASML's monopoly on advanced lithography equipment has been treated by investors as something close to an unbreakable moat, one that justified premium valuations across the entire chip equipment sector. The moment credible evidence emerged that this moat had its first real crack, even a small one, even limited to a less advanced equipment category, investors began reassessing what the next 5 to 10 years might realistically look like, rather than reacting only to this year's actual production numbers. That kind of re-rating, where a stock's valuation shifts because market assumptions about a company's long-term competitive position have changed, tends to produce exactly this kind of outsized single-day reaction, disproportionate to the immediate current year business impact. It's less about 5 machines shipping this year and more about what it might mean if that becomes 50 machines in 3 years, following a scaling pattern similar to how other Chinese manufacturing sectors, solar panels, batteries, shipbuilding, have moved from a slow initial breakthrough to rapid scaling once the fundamental technology got proven out. Whether that specific pattern repeats for lithography equipment, given how much harder this particular technology is to scale compared with those other sectors, remains a genuinely open question, and reasonable analysts disagree. Step back, and this story fits a pattern this channel has covered before. China responding to Western technology restrictions, not by giving up, but by finding an adjacent, imperfect path forward rather than waiting for full parity before making any move at all. Blocked from purchasing ASML's most advanced EUV machines and facing tightening restrictions even on some categories of DUV equipment, a bill has reportedly been introduced in the US, aiming to fully ban immersion DUV exports to China and restrict maintenance services on machines already installed there, naming SMIC, Huawei, Huahong, CXMT, and YMTC as covered facilities. China's response has been to invest heavily in developing domestic lithography capability, starting with the less advanced but still meaningfully useful DUV tier first. That's a sensible strategic sequencing, rather than an attempt to leap straight to EUV parity, which remains a considerably harder engineering challenge. Huawei's connection to this effort through Carrier is significant, given the company's broader track record navigating around export restrictions through sustained, well-funded internal development, most visibly demonstrated already in its domestic AI accelerator chip program. That history matters here because it suggests an entity with real demonstrated experience building around restrictions through internal investment, rather than waiting for restrictions to be lifted. Even so, the export control response worth watching is genuinely uncertain in which direction it cuts. One argument suggests remaining restrictions could tighten further since a credible Chinese alternative, even an inferior one, weakens the diplomatic and commercial case for keeping any legacy access open. The opposing argument suggests policymakers might conclude restrictions are increasingly accelerating rather than preventing Chinese domestic development and ease certain categories instead. Whichever direction policy moves, this specific episode will likely factor into discussions in Washington, Brussels, and Tokyo over the coming months, precisely because it offers concrete, verifiable evidence about how effective current restrictions have actually been. Here's the honest read, after weighing both the dramatic headlines and the more sober analyst commentary that followed. The market's reaction that week likely overshot the actual near-term business impact of this specific piece of DUV news on its own. 5 machines scaling to 20 against ASML's roughly 130 annual shipments isn't, by itself, a business-threatening near-term shift. And the yield and reliability questions analysts raised are legitimate, not dismissive spin from a threatened incumbent. At the same time, it would be a mistake to treat this as meaningless. It's a genuine technical milestone, and historically, this kind of proof-of-concept moment has preceded much faster scaling in other Chinese manufacturing sectors once the fundamental technology gets demonstrated in production. What's most interesting about this story is how clearly it shows the gap between market psychology and near-term business reality. Both can be true simultaneously. The immediate impact on ASML's 2026 business is genuinely limited. The strategic significance of ASML's monopoly showing its first real crack is genuinely important for how the entire industry gets valued over the coming decade. It's also worth remembering that this specific crash wasn't a clean, single-cause event. It landed in the same 48-hour window as a record Chinese memory IPO and renewed doubts about AI infrastructure financing. And untangling how much each factor actually contributed is something the next several months of production and earnings data will clarify far better than one dramatic trading session ever could. There's a broader lesson here too, worth keeping in mind for every future headline in this space. Markets, and honestly, a lot of news coverage generally, tend to compress complicated multi-year technology trajectories into single dramatic moments: a stock crash, a product launch, a surprising earnings call. The reality of how semiconductor manufacturing capability actually develops is almost always slower, messier, and more gradual than any single headline can capture. That doesn't mean these dramatic moments don't matter. This week's reaction genuinely does reflect a real shift in how investors are pricing long-term risk across the sector. But treating any single day's stock movement as the definitive verdict on a technology race this complex, this capital-intensive, and this dependent on sustained execution over years rather than months is almost always a mistake. So here's what I want to know from you. Was the market's reaction a rational repricing of a genuine long-term threat, or panicked overreaction compounded by several unrelated shocks landing at once? There's a legitimate argument on both sides, and I'd genuinely like to know where you land. Drop your take in the comments below and be specific about which of the three factors you think mattered most, because I read every comment, and I'm curious where the audience actually splits on this one. If you want to keep following exactly how this lithography race unfolds, alongside everything else happening across China's chip, materials, and manufacturing industries, that's exactly what this channel covers every single week. Hit subscribe so you don't miss the next update, because between ASML, Nvidia, Samsung, SK Hynix, and China's own equipment makers all racing toward the same technology, this story is genuinely just getting started. See you in the next video.